Continue with the example, and the next thing we'll talk about is going to be sufficiency of working capital. Remember, working capital is supposed to be the difference between current assets and current liabilities, but looking at a difference is not very scalable, and that's why we ended up with a couple of different ratio measures. We have two ratio measures here of sufficiency of working capital, which are the current ratio and the quick ratio. Now, the way that we've been interpreting these things is it starts to illustrate for you the probability that this firm will be taking out a loan or selling an asset in the near future in order to meet some current obligations of some sort. Now, we have the two ratios which are very, very, very similar to each other. So if we go back over to our sheet of accounting ratios, you can see that the current ratio is just current assets over current liabilities, and that the quick ratio is current assets less inventory over current liabilities. And it's this little difference in the treatment of inventory which is really important. The idea is that in the current ratio, your inventory is considered to be easy to sell. It's something that everyone wants, and you can sell it for approximately what you bought it for. The assumption that you're seeing with the quick ratio is that nobody wants your inventory. Your inventory is effectively worthless. Now, reality is someplace in between the two measures. Most inventory is not sellable for exactly what you sold it for, nor is it going to be worth absolutely nothing. So you can think of these as an upper and lower bound on sufficiency of working capital. So it's really going to depend upon what your industry is like and what your inventory is like within your industry. So let's take a look at the current and quick ratio right here and sort out which one of these two firms is more likely to take out a loan or sell an asset in the near future to meet current expenses. Well, the idea is that firms which have high current and high quick ratios are ones which are less likely to take out a loan or sell an asset in the near future to meet current expenses. You can see that large numbers exist because the assets are going to be relatively large relative to these liabilities. So, if you go ahead and spot which firm is less likely, I would say that it would be firm B, on the basis of looking at the current ratio. If you were going to see which firm was less likely on the basis of quick ratio, you would be looking at firm A. Now, what we're seeing right here is a difference in the size of the inventories of the two firms, and which one of these you should consider really depends upon the industry. Now, if inventories are going to be highly valued elsewhere, then you'd go ahead and look at the current ratio, and you'd find that firm B would be less likely to take out a loan. Firm A would be more likely to take out a loan. If, on the other hand, inventories are not highly valued, you can't sell them a lot elsewhere, then firm A would be less likely to take out a loan or sell an asset, and firm B would be more likely to take out a loan or sell an asset. Now, what's also important is if those inventories are just plain small relative to all the current assets right there, in which case it probably doesn't matter which one you use. Now, let's continue the example to look at these final two ratios right here, the inventory turnover ratio and the asset turnover ratio. Going back to our document that has all our accounting ratios on it, you see that they are both going to compare a stock value with a flow value. The flow value is going to be up in the numerator. In each case, it's going to be total revenue. And down in the denominator is going to be a different kind of stock value. Inventory turnover has average inventory balance, which is just the inventory that was there in the time period where you ended the income statement period, and the balance of the inventory on the balance sheet where you started the income statement period. What you're going to have for total assets is just going to be the assets in the balance sheet associated with the income statement. Now, inventory turnover is supposed to describe how big of a buffer stock this inventory is relative to revenue. So you're talking about how many times did your inventory get sold through during that last accounting period when you're reporting the total revenue. What you're seeing on total asset turnover is the number of times your assets have reproduced itself during a similar kind of period. Inventory turnover is great for dealing with those kinds of temporary shocks that are there. So can you go ahead and handle those temporary shocks? Asset turnover is talking about permanent increases. Now, let's go ahead and get back to our example here. And the interpretation is, again, probability that the firm can fulfill a large, either temporary or permanent increase in sales. So what we would like to have here are, so in general, if we're looking at the ability of a firm to fulfill a large one-time order, we're looking to have large inventories relative to sales. And large inventories relative to sales means that we are dealing with a small inventory turnover. So if you head back over here, you see the firm that has the smallest inventory turnover is firm A. And that's the one that has a relatively large inventory. So you can think of these as the examples I gave before. It's Hippo Hardware. It's going to be someplace that has a deep catalog that's there that you can go ahead and plug through. And they're very likely to be able to fulfill your needs if you should go ahead and walk in. Firm B, on the other hand, is less likely to do so because its inventory is small relative to its sales. Now, Firm B probably has lower inventory costs. That's the interest associated with it and then all those warehousing costs, but they're less likely to fill your needs each time you want to walk in there. Now, again, that's just a one-time sale. Asset turnover is going to help you with those multiple sales, those sales that are going to go on for a long period of time. So it's the ability to go ahead and be capable of expanding. Now, if you go ahead and glance back over here at the total asset turnover, you see that if you want to have the capacity to increase your revenue, what you're looking for is having a relatively large asset base. Large asset base means the total asset turnover is going to be relatively small. So again, if you want to see which one of these firms is most likely to fulfill a persistent increase in sales, I have it rigged, so again, it's going to be Firm B that does it rather than Firm A. Now, please note that having lots of excess capacity sitting around is just as expensive as having excess inventory hanging around. It means that you're paying an awful lot of money, and the proper number is likely to be someplace in the middle. And so this should go ahead and conclude our examples of how these inventory ratios are used. And we'll go ahead and move on to the next topic, which is time value of money.